All right, in our last video here, we're going to look at the venture capital method. So the venture capital method is kind of a shortcut method where we're going to think not really about all the explicit cash flows between now and the terminal value, but instead we're going to think about what's our exit value or how much we're going to get out at the terminal period relative to what our investment is today. All right, so we're taking our investment today plus that discounted value of whatever our exit value is, and that's how we're going to get the valuation of the company in this perspective. All right, and the reason that this is more conservative is relative to the pseudo-dividend method. What it's going to do is take any surplus cash that we generate along the way, right, through those explicit years, and it's going to push that all forward to the terminal period. And again, wrap that into what we call the exit value. So now we're basically taking what were interim cash flows and we're delaying them, right? So if we delay those cash flows, they're going to be worth less in the future than they are in the kind of interim periods. And thus, we're going to get a lower valuation doing this method. All right, let's see what it looks like compared to our prior model example. So here what I'm going to start showing you is what we started with last time in our pseudo-dividend method. And notice we have explicit cash flows and present values on those explicit cash flows. At the end, we get a total present value of $1,000. Again, that's the net present value. Now, if I flip over to the venture capital method, the difference is that we make all these cash flows zero over this period. All right, so there are no explicit period cash flows. And instead, what we're going to think about is how much cash can we get down here at the end of our explicit period, so period 5. And notice now that this cash flow is a lot bigger. And the reason is now we're taking the change in surplus cash, not year over year, but from time 0 all the way out here to time 5. So in this case, we get $553 of cash that's now available in year 5 to be paid out. So that gets discounted back to the present value, added to the present value of our terminal value, which again is the reversion value. And now you see we get a present value of $928. So that reduction from 1,000 to 928 is because we took all of these interim cash flows, right? These changes in surplus cash between 0 and 1, 1 and 2, etc., and we push them all out to time 5, so we're not getting those cash flows as quickly. That gives us this reduction in value. Now in the VC method, I also talked about this idea of an exit value, right? You're not always going to think about what are the explicit cash flows versus what is the terminal value of everything going forward. And so we can also wrap this into essentially the exit value, which in this case would be the surplus cash at time 5 plus that terminal value. So we're going to get the same answer if we think about that exit value and then discounting that back to time 0. And that's because both the terminal value and that year 5 total cash flow are both discounted back 5 years. All right, let's go back and return to our slides. So now I want to give a different example that we can work through in these slides. So we're going to assume that we have an investment opportunity where the entrepreneur needs $1 million today, right? Whatever it is that we're going to make, we'll say widgets. I need $1 million to invest in my widget factory to make this project run. If things go well, then I expect that in 5 years that we can sell this business for $10 million, right? This is based on other companies that I've seen do similar projects, so we can have some market-based estimate for what our exit value might be. But we'll say that's $10 million. Also, based on kind of how these other companies have done, we assume a 50% discount rate. So this widget business is very risky. 50% is a really high discount rate, but not all that crazy for startup type businesses. All right, so with that, let's also assume that as the owner, I have 2 million shares of stock in the company. I'm the sole owner. 2 million, we're going to see that that's pretty arbitrary. We could call it 1 share of stock and just divide it up, or we can call it 2 million or 2 billion shares for all we care. We're going to ultimately divide the company based on percentage of ownership, and we'll use the shares as a way to represent that. Now, a couple pieces of terminology before we go on. First is pre-money valuation, pre-money and post-money valuation, these two terms. So the pre-money value of the company is the value of the company before a new investment or new money comes in. The post-money valuation or the post-money value is the valuation after that money has come in, right? It seems rather intuitive, but we're going to see a couple distinctions between pre and post-money valuation that show it's really important that we think about whether we're talking about a pre-money valuation or a post-money valuation. So in our example, we're going to assume for the pre-money valuation that what we have is $1 million investment We have $10 million coming out in year 5. We're going to discount that back at the 1.5% for 5 years, and that gives us a value of about $300,000. So that's the pre-money value of the business. Once we have that $1 million of investment come in, well, that's going to counteract that $1 million of outflow initially, right? We have $1 million of equity come in, we have $1 million go out to pay for that factory. Now we have a zero cash flow at times 0. So all we have is that 10 million divided by 1.5 to the 5th, which gives us about 1.3 million. Notice that the post-money valuation is exactly equal to that pre-money valuation plus the amount of the investment. So post-money is just pre-money plus the new value of the investment. Now let's think about how we would split the company between the entrepreneur, who has this business plan and knows how to basically turn widgets into a company that could be very valuable, and the investor who has $1 million. Right? When we think about the post-money value, that's the combined value of that investment and that business plan put together. All right? So we can really think about that as the pie that we're dividing up. And the amount that each person gets is based on how much of the pie they contributed. So the investor will get 1 million divided by the 1.3 million, which is about 76%. The entrepreneur, they contributed the 316,000, which divided by 1.316 million gives the other portion about 24% of the company. All right, so let's see what this looks like in our example. So in our example, we know that the pre-money valuation is the same as the value of the business plan. This 928 is just linked to the total present value of all those business forecasted cash flows. Now, that is the entrepreneur's value. The investor's value is the value of that new investment they're going to make. We're going to assume it's exactly equal to the amount that we need to put in to buy our factory, so it's that $1,000. And so in this case, when we put those together, the post-money valuation would be the sum of those, or the $1,928. So if we want to get our valuation and figure out how much each owner gets, whether the entrepreneur versus the investor, well, we can just take how much the entrepreneur puts in divided by the sum of what both the entrepreneur and the investor contributed. The investor is the exact kind of the flip. It's their amount they contributed, that $1,000, divided by the 1928, or the combined value of the company. We can also see this in a post-money valuation. So if I flip over a tab, we're going to see a couple changes in what the post-money valuation looks like. First, notice our surplus cash now is always positive. All right, this is a valuation that this is a set of financial statements that you'd rather show to an investor, right? It shows positive cash balances. Things look like the company's not going bankrupt, right? Notice from a valuation perspective, we're going to get the same answer. In this case, we're going to get a post-money value of 1.928 million. So all we've done is taken that 928, added in the investment amount to get to the 1,928. All right, and mechanically, the only thing that changed is now we have times 0 surplus cash because we had to pay out that $1,000 of investment, but we also had that $1,000 coming in from our investor. All right, so otherwise, everything in this model is the same. We've just added that initial investment in from the investor. We now get a different post-money. We get a post-money valuation that is the pre-money plus the investment, and we get the same exact splits. Right? We have the same contributions from the entrepreneur and from the investor, and we get the same splits in ownership of about 48% and about 52%. Again, the big difference is how do the financial statements look? In the one case, post-money, our balance sheet shows positive cash values. In the pre-money, we see a bunch of negative cash values, which again can scare some investors. But again, this is not necessarily to present to investors. This is from a valuation perspective. And from a strictly valuation perspective, either way, doing pre-money or post-money are going to give us the same end of the day answer. We just have to be really careful whether this 928 is pre-money or post-money, and conversely, whether this 1,928 is pre-money or post-money. As long as we keep those straight, we'll be able to divide the value of the company appropriately.